It's interesting to me that I still hear people saying that inflation is not coming down, that it's not going to come down anytime soon, and that home loan interest rates are going to remain high and maybe even be in the sevens throughout 2023. I really don't see that as being the case, especially because we're not in the sevens even now. And if you go back and you look at my projection for 2023, all the things that we've laid out really make sense and seem to be following into that path that we laid out. So today is January the 19th, 2023. It is now 3:07 p.m. Central Time. Welcome to the Brent Bruce Daily Today. Now, yesterday we had the producer price index that I was talking about being excited for. Unfortunately, I got home really late yesterday, so I wasn't able to put the report out to tell you what happened. Producer price index came in showing inflation greatly lower than even the expectations. I mean, it was way lower than expected, which is great news for us and continues to show that inflation is coming down. Now, if you see the producer price index coming in low, what is that? What can we expect in the future when it comes to the consumer price index as well as the personal consumption expenditures report? Well, you should expect naturally that if the producer price index is coming down, that the consumer prices would come down as well, because the producers are in front of the consumers. That's to be produced before it can be consumed. So that is good news for us in reports to come, that they should fall in line with the expectations from our earlier annual projection. So let's take a look and see exactly what we've got going on. Home loan interest rates are improving because of that, but we're going to take a look at that as well here in just a moment. So here is the report straight from the horse's mouth. This is from the U.S. Bureau of Labor Statistics, showing the total. So this is the total number for the producer price index. Now here you see the low point that we were at back in April of 2020. That was negative 1.5%. After basically COVID started hitting and all that kind of stuff was going on. Money started dumping into the economy and inflation shot up. The producer price index immediately and quickly went up to 11.7%, which is extremely high. Now, since the effects that have come through from the Federal Reserve increasing the federal funds rate, we have seen inflation come down on the producer price level to now 6.2%, which is very good to see. Now, as the producer price index went up, what also went up? Home loan interest rates. Interest rates started going up somewhere in this time frame, March, April, and they started to really go up quickly because of seeing these reports coming out consistently showing inflation coming up on the PPI, the CPI, and the PCE. If you don't know what those things are, go back and watch some more of the videos. So where are we as far as if we were to remove food and energy? So the core number for the PPI, we take a look at that. We peaked out at what is this number here? 7.1% in March of 2022. And again, look at the reduction, the consistent reduction coming in. Now we're at 4.6% for December of 2022. So again, the producer price index is showing inflation coming down. Where are we as far as our home loan interest rates? Because of that report that came out yesterday. We should have had a great day yesterday, correct? Well, we did. So we had a good day, but we banged up against this tremendously difficult ceiling of resistance at 101.671. Look at how long we've been fighting this ceiling of resistance that just is really proving to be a very tough customer. We banged up against it, came back down, closed in this range here. Today, dropped down. Earlier today, I was seeing numbers that were really in the red and negative. Right now, we're kind of coming back up and beginning to test this ceiling that is over us as well. We're up 3 basis points, not a whole lot of movement. The 10-year Treasury also is up 2. This really matters to us. The 10-year Treasury really matters to us. At this point, you can see that we have broken below this floor of support, which we want to, but here we are coming back up and kind of banging our head on it. Now, remember, this report we want to show going down. We'd like to see us coming down, testing the 200-day moving average, which is right here. But it looks like we're kind of moving the other way, which makes sense. I mean, we've had a very good run for a while. This doesn't go down in a straight line. It's kind of up and down. So we are in a good position right now still. Home loan interest rates, how are they feeling about it? And what are the banks passing along to us? So let's take a look at some scenarios here. Now, I want to show you a couple of scenarios because I want you to know what is out there. So let's take a look at the regular traditional Brent Bruce Daily 30-year fixed conventional for a very well-qualified customer. And this is going to be in the state of Tennessee. You know, I do business in Tennessee and California, but I'm going to show you California as well. So here we are. Right now, 5.999 is available to us with no points, actually with a credit of $205. Let's open this up and take a look at what it takes to get us down a little bit lower. So if we were to pay just under a point, we're at 5.625, just over a point, we're at 5.5. Now, guys, you all know that right now sellers are willing to pay points. It depends on how it's, the deal is structured, but getting a few points, maybe a point or two from a seller to either pay for a 2-1 buy down product or to pay for just a straight interest rate buy down is pretty common right now. So keep that in mind, that for us to get to a 5.5% on a 30-year fix is realistic today. A lot of people do not know that. Okay, so I mentioned that we're going to take a look here. Let's open this up here. This is the scenario. We're going to look at a couple of different things, some actual scenarios. So first off, this breaks down the scenario we just looked at. People always say, well, why don't you show California? A lot of the people that I work with are in California. We're going to submit this exact same scenario with a California zip code, and you're going to see it is the exact same. So as I go through here right now, 5.999 and a credit of 205. So the pricing in most cases is exactly the same from California or Tennessee. That is why I do that. And really most of the United States, there's not a whole lot of difference from state to state. But here's something I also wanted to show you. Let's take a look at the FHA, because realistically, you guys probably know that the first-time buyer is a tremendous market right now. They are really waiting to get out and buy houses. And traditionally, they're going to be looking at, FHA, USDA, some VA is a great option as well. Now, right now, we're taking a look at, again, this is a scenario. This is based in Tennessee, very well qualified, 800 FICO score, 3.5% down. This is not 25% down. This is 3.5% down, and we're going to submit this file. Let's go ahead and give you something a little bit more, I don't want to say realistic, but palatable. So let's go with like a 700 FICO, or even let's do a 690. Let's do a 690 FICO score on an FHA loan. Right now, you are at 5.5% with a credit of $613. On 3.5% down, guys, this is the real numbers. Let's open this up a little bit. And what if we get a seller to pay a point? We're at 5.0. 5.0 on an FHA loan with 1 point, 30-year fixed. This is a real number, guys, and that was based on a Tennessee number. So what if we go again? Let's just for making sure that it's the same. 91730 is a California zip code. Let's run this here, and you're going to see the same. So right now, 5.5% gives you a credit of $613. Let's open this up a little further. Oh, you know what? It was not. I'm going to correct something because that. Oh, yeah, 690. Okay. So if we were to pay a point, 5.0. 5.0 on an FHA loan. And that's pretty much the same. Usually we're very, very close on our USDA and our VA products as well when it comes to the FHA. So we're in a good position, back into the fives with pretty much any product right now without any points. We are waiting and anticipating the personal consumption expenditures report that is going to be coming out January the 27th. And that will be our next big report that comes out that will move us one way or the other and know if we're going to continue down the path that I laid out here in early January on how we're going to get to that 4.875 with no points on a conventional, very well qualified client. Let me know your thoughts. If you have any questions at all, make sure that you like, subscribe, and share. If you have not done that already, have a great day. I'll talk to you again tomorrow.